Welcome to APM466 or MAT1856, depending if you're an undergraduate or a graduate student. So this is a course which is devoted to give you an introduction to mathematical finance. The course is structured, taking into account why you may be here. And I've been doing this for a long time, so I'm gonna take a guess, and you tell me if I'm right. So some of you are here because you'll be looking for a job this year. Yes, how many of you will be looking for a job? Okay, good. Some of you will be applying for graduate studies this year. How many of you will be doing that? Good, okay. Some of you will be looking for a job next year. Exactly, yeah, okay. Maybe someone is just curious about mathematics and finance. You're not looking for a job, you're not interested, you're just curious, right? Okay, yeah. And maybe any other? Any other motivation? Okay. So the course is designed for you, taking that into account. So this is 12 weeks of lectures, 3-hour lectures, the objective of which is to get you prepared for what you want to do. That's this course. Now, why am I here? I want to help you. That's the main reason why I teach this course. And the course is structured like that. It's been doing it for a long time, since 2001, and I've learned a few things over the years. The course has been changing over the years. Every year it's a different course. This year will be different from last year. Not very different, but slightly different, because the world is changing and I need to change with the world. I want this course to be two things. I want the course to be useful. That's number one. What does that mean? That means that after you take this course, you're better prepared for the objectives that you told me are your short-term objectives. So usefulness is a very short-term value. Okay? So I want this course to be useful. I'll tell you why I believe I can do it. But I also want it to be valuable. Valuable is a long-term proposition. I want what you learn in this course to stay with you for a long time. I don't want to just help you, give you tips to get your next job interview to be successful. I also want you to learn things that hopefully could be with you for a long time. I've been doing this for a long time. I've learned things over a long period of time, and I'm looking for that universality, these things that will stay with you for a long time. And I'm doing that by selecting topics in this course carefully. I am very proud to say that I want to favor breadth to depth. And I'll be very explicit about that today. And I aim to help a wide variety of students. I am pretty sure that if I went through your backgrounds and what you've studied, you're all very different. This is typically not a course taken by students who are carbon copies of each other. And I want to also design this course so that I can be useful to a very wide variety of people. What am I talking about in this course? I have here the weekly schedule. Let me go through that so you see what's coming. So today, I'm going to be talking about money. Money is the reason you're here. Perhaps not because you want to make money, but everybody needs money. And there's a whole part of society which is organized around that. That's what finance is about. And a few decades ago, mathematics became very relevant in some of the developments that happened. We're going to learn all of that today. We're going to learn history, perhaps not today. And today, mathematics and finance have a very nice relationship, which is affecting society in increasing ways, and that creates employment opportunities and education opportunities and everything. And that is what I will address today. Today is going to be a very generic discussion about money. Now, next week, I'll talk about money and time. As you know, time is money, and we're going to get very deep into that relationship, how time and money are related. And it's going to be a feast of mathematical concepts and developments that we will do just to understand the relationship between time and money. That's next week. After that, I'm going to switch into the asset pricing theory part of this course. It is an important part of the course, but it's not, I have to say, it's not as important these days as it was, say, 20 or 30 years ago. Pricing is what made mathematics relevant in finance. Today, perhaps that's less the case. Machine learning and artificial intelligence and the mathematics that comes with it are changing the way finance works. But still, we're going to be looking at pricing theory. We're going to go back to the classical theories that made mathematics what's today in finance. And I'm going to devote 3 weeks to that. The first is going to be the very simple one-period models, the things that you really need to understand, the things which are very universal, and they're going to be with you forever. Then I will look into the multi-period and the more complex treatment of asset pricing. And then I'll do the continuous time models, the part that where mathematics gets to be very sophisticated. And I'm really going to skim through the surface of the mathematics. I'm going to focus more on the finance, less on the mathematics. We're going to do that. Oh, by the way, I have to say February 2nd, the lecture will be purely online. I will be in Germany that day. I cannot lecture in person. That may happen several times this term, but for sure, February 2nd, I will be in Germany. We'll be lecturing online. As you know, and I think everybody's aware, as people, this course is simulcast. It's done on Zoom, even when I'm here, and in person when I'm here, which will be hopefully most of the days. Okay. Then on February 9th, I'm going to do something which I will do mostly for historical reasons. That's the Black-Scholes theory. When I started in finance, and I'll tell you the story of my involvement in finance, the Black-Scholes theory was the pinnacle of mathematics and finance. If you knew the Black-Scholes theory, you will get a job very, very quickly. Today, it doesn't matter if you know it. It's better if you do, okay? Maybe if you don't know it, you're going to have some handicap, but it is not what it used to be. So the Black-Scholes theory is I'm going to pay homage to tradition and to history. It's perhaps the one topic which is not as relevant today as it has been in the past. And then I want to switch to risk management. I want to spend 3 weeks on risk management because still today, risk management is the main source of jobs for those of you quantitative people, mathematicians, physicists, chemists, engineers who are interested in the financial sector. And I'll explain why. We're going to spend 3 weeks on that. Then we're going to spend 2 weeks on investing. Investing is the thing which is closest to my heart. I spent 20 years in that space, I'll tell you. And I want you to understand what investing is, and I think I can do that in 2 weeks. And then the last lecture is devoted what I believe is the most useful part of this course for you. I'm going to devote a full 3 hours to communication skills. It's very unusual that a math course has a section on communication skills. But again, I've learned over the years that this is critical. And I want all of you to at least be aware of what that means and why that's of relevance. So that's what we will do. Now, a little bit about me, so you understand how I approach this course. I started to be involved in mathematics and finance in 1996 in the most unusual way. I had just arrived in Toronto. I arrived in Toronto in 1992. I came here. I was doing mathematical physics. I finished a very big paper, made me very famous, mathematical physics, and I got a call. A company in Toronto, a software company in Toronto, was doing financial software for the banks. I knew nothing about finance, zero, nothing. I knew a lot about computers. My PhD thesis at Princeton was about computer-assisted proofs. It was one of the first computer-assisted proofs in mathematics. It was in 1989. So I knew about computers, but I didn't know anything about finance. They called me because it was a very interesting company. It's been one of the great Canadian success stories. It was created by Ron Dembo, one of the Canadian visionaries that we have had. So in 1987, 89, I think he was at Goldman Sachs, and then he created a company doing something that was very unusual at the time, and that was to use computers to do heavy-duty financial calculations. He started in the energy sector, then moved to the banking sector. And in 1996, when we studied a chapter on risk management, you will see something happened in 1991 that made 1996 a very important year for mathematicians in finance. And this company was looking for people that didn't exist. They were looking for people that knew finance and knew how to do computer programming, who knew C++. That's what they were looking for. C++, you familiar with that term, C++? Okay. They were looking for that. These people did not exist. So they had two choices. They could hire people who knew C++, mostly engineers, and they put them through training. Typically 9 months was the learning curve, 9 months of training. So they learned the finance, and then they would become very useful employees. Or they could hire people that knew about finance. At that time was typically MBAs. Then put them through training so they would learn C++. And that didn't work. So they were looking for an individual that had both. What they offered me was to create a research lab here at U of T that they would fund. So I would welcome people who knew C++, mathematicians, physicists, engineers, and then we would work on financial problems. And that was a huge success. These people would be hired immediately. The learning curve was shrunk to 0. They became successful employees on day 1. And Risk Lab was fantastic. It was very, very successful. We're still there. We're still doing that, except this company does not exist anymore. It was sold many, many times, eventually to IBM. I don't know, or just was a very great success. But the idea continues to be there. At the same time, I developed other things. We developed a master's in mathematical finance at the University of Toronto. Risk Lab was a very important element in the creation of that. Some of you may be applying to the master's in mathematical finance. That started thanks to the Risk Lab of 1986.
What is Risk Lab? Is it
Sorry?
What kind of organization is Risk Lab?
Risk Lab is just the name of a research group at the University of Toronto. That's all it is. Mm-hmm. And then in 1999, Risk Lab became successful in the sense that one of the research projects we did became a company. Initially, it was going to be a company that was going to do some investment, minor investment activities. It became a very big company. So the company was around for almost 20 years. I was the CEO of the company, and we managed, it was an investment company. It became an investment company. We managed about $1 billion of assets, mostly pension assets, Canadian pension assets. And for me, that was wonderful. I stayed a professor all that time, and I stayed as CEO of an investment company all that time. So you can imagine how much I learned. And that shaped me into what I am today. And this course is influenced by all of that in a very major way. I had a very special relationship with the banks. I was a very good client of the banks. My company was. I was making investment decisions. My company was making investment decisions every day. And I learned that business quite well. And that's something which I will bring to you. By the way, there are 2 weeks in this course devoted to investment theory. That's what I'll do towards the end. Okay, it may be the most entertaining part of this course. That's the one that has been closest to my life. Now, since then, I've done other things. Oh, the company died of COVID, by the way. We had developed a product for German insurance companies. It was a fantastic product, but we couldn't sell it. I was stuck in my basement, like all of you. So it was one of the casualties of COVID. Okay, I closed the company, and then I started many new things. The first thing I did is I started the FIT Center. Some of you are doing the CFA. The CFA is so obsolete, very old, right? It has no technology in it. So the FIT is my attempt at creating the 21st century version of the CFA. It has slightly different focus. We have, instead of having people, we have companies be part of that. So, BlackRock is one, Morgan Stanley. These are my. So it's a great. I'm very passionate about that. It's a great thing. We also created the Center for Sustainable Development at the Fields Institute around the same time, 2022. And that's something which I have 1 hour lecture devoted to sustainable finance. So we'll take a little bit of a peek at what that's all about. Let me advance it from the financial perspective. I've gone public in saying that sustainability is the new .com. The biggest companies in the world will be the companies which today are operating in this space that we call sustainability. And if you don't believe me, imagine a company that can create free, unlimited energy, for example. Okay? We're very close to that. So, but anyway, so we created that. I am the chair of that center, and that center has an office, a representative office in Shanghai, which I run. So that makes me, of all places, a very unexpected presence in China. So I'm very actively there. Okay. In fact, if I had to teach, I told you one day I'll have to teach online SLP in Germany. Germany is a place very close to my heart too, because I actually created a company in Germany, the one that died of COVID. But now the place that I travel most often is China. And if anyone wants to know about that, just let me know. I may have to be there every once in a while, and if that's the case, I'll have to lecture online also. But I'll let you know, okay? Typically, I will know these things ahead of time. Now, let me tell you what I will not do. These are the things that I will not do in this course. If you're expecting that in this course, this is not the course for you. I'm not going to do rigorous theorem proof sequences. I'm not doing that, okay? There is one theorem that I like to prove in this course. I'll prove it in a few minutes, but I'll spend a lot of time giving you the framework for that. It's a theorem which is important to know, but this is not that type of a course. If you're expecting a mathematics course like the ones which are traditionally taught, the ones that I have taught many times in my life, this is not it. This is a course that's going to focus very much on finance, and I will take your mathematics for granted most of the time. You may learn some new math here, but I will take the math almost for granted. I suspect all of you know a lot of math already. So I'm not doing that. I'm not going to do a full coverage of any single topic. Most of my lectures are monographic. I lecture for 3 hours. I start and I end. And when I end, I'm done. If you want to know more about that, there's lots of references on the website. I'll show you that. There's places where you can go and learn. And you will be very well prepared to learn on your own after that. But I am not going to cover any topic 100%. Nothing. Okay? I prefer this course to be very varied and diverse than very intense, so that you become world experts on topics A B, or C. I'm telling you, I don't consider that to be very useful today. Okay. One of the things I will also not do, I'm not following a textbook. There are many textbooks that could apply to the different topics that I lecture about. Typically one textbook per day, per week. So that's impractical. And I believe that in this day and age, you can, if you have a question, just ask ChatGPT, and then thin textbooks don't have the use that they used to do. But there's one thing that I like to. I'm quite proud of this comment. This is the only review I could find publicly on my course. If anybody has found other reviews, let me know. Okay, I'm very curious. But I found this one. There's someone who it didn't like my course, and I'm very proud of the reason he or she didn't like it, because that's exactly what I intend this course to be. So this person was very annoyed that I didn't explain a lot of concepts very well. I don't agree with that, but I agree with what he's trying to say. He says that, for example, I spent portion of the course talking about the Black-Scholes equation, which requires stochastic calculus as a prerequisite. And I didn't explain stochastic calculus. Of course not. There would be then a course on stochastic calculus, and frankly, that's a different course. Okay. So again, this reflects very well my intentions for this course. At the end of this course, I want you to be able to go out there and live in the financial sector and prosper and do well. There's lots of courses about lots of other things. And this university has lots of courses about lots of other things. But I think courses like this are more rare. And that's the course that I want to give. Okay? So this comment with whom I agree 100% reflects very well my intentions for this course. Okay. So having said that, I am now, I guess, ready to start lecturing. Like I said, the topic of today is everybody needs money. And this is the reason, at the end of the day, that this course exists. So let me review the financial sector for you. I don't know how much of this you know. I'm assuming that you know something, but I'm also assuming that if I take the intersection of all the things that you know, that intersection is very, very small. So I'm going to assume that there will be things that you don't know. So the financial sector has essentially 5 parts to it. One is banking, the one that most people consider and look at, banks. Okay? And banks are, yes, they do exist. They are a very important part of the financial sector. Many of you will be working in a bank. I don't know, maybe some of you will create a bank. Why not? Now, let's reflect on the banking business, because that you may not know how banks make money. Banks make money on fees or interest, and that's about it. Okay? Banks don't typically make money trading or buying and selling stuff. It's a very common misconception. Sometimes they have to buy and sell something so they can sell you a product for which they charge you a fee. But banks love fees. The best business a bank can have is that fee they charge when you do an Interact transaction. That's the ideal. So how would a course like this fit into that model? Well, we'll find out. We will learn. Okay. Now, the asset management industry, this is the investment industry, is a bit different. Because what do they do there? They take money from their clients and they invest it to create more money, essentially. How do they get paid? They get paid most of the time through what's called management fees. So you give them money, and one way or another, they will find a way to charge you 1% of that. And that's how they make money. Whether they make the right decisions or the wrong decisions, they typically will charge you the same, 1%. How would a course like this fit into that? Well, yes, sometimes they charge performance fees too. And to charge performance fees, you need performance. And for that, you need to make good decision making. But frankly, most of the time, Like 99% of the asset management sector works on management fees. You don't have to be, you just need very good salespeople. So anybody here is up for a sales job, by the way? You should consider that, okay? And I'm I'm not joking, I'm very, very serious. More and more, you're gonna see more and more people with math skills as salespeople, because that's the one area where mathematics is revolutionizing everything also. But we'll talk about that some other time. Now, the insurance sector. What does the insurance sector do? You give them money, and when something bad happens, they give you more, right? Why would a course like this fit into that? Well, the insurance companies, what they have to do with that money that they collect is first they have to figure out that they charge the right amount, and there's some math that goes into that. But also they need to invest it, because if the money that, say, is a life insurance, and you collect money, and then they have to pay you, well, not you, someone else when you die, right? Well, that money cannot just be sitting there. Typically, the money has to grow, and it's expected to grow. And the companies, the insurance companies, pick up liabilities that will force them to make their money grow. So most insurance companies are actually asset management companies in disguise, with very good salespeople selling insurance premium. But then that premium becomes the feeder for asset management companies. In fact, when it comes to asset management companies, we are in Canada. You know the biggest asset management companies in Canada? Canadian pensions. I don't know what you were going to say. But sorry?
I was going to say Manulife.
Okay, Manulife is it's a very interesting Canadian success story. Yes, Canadian pensions are bigger, far bigger than Manulife. But Manulife is essentially, it started as a mutual for, is the manufacturing life a trust for people in the manufacturing sector, right? So very similar to what an Ontario Teachers would do today for the teachers of Ontario, or what Canada Pension Plan would do for the Canadian citizens of Canada. Very similar. So, and Canada is one of the leading countries when it comes to that. Our banks are not very big. Yes, we have a TD, third largest bank in New York. Yes, we have Royal Bank, very big bank. We have Scotiabank, very big bank in Latin America. We have some interesting banks, but the big banks are US banks today, okay? But the big asset management companies, the sophisticated asset management companies, most of them are in Canada. And because of that, I predict that many of you will actually be working there, at the pension plans, for example, okay? What you will do there, you will see in this course, and I'll equip you with the knowledge you will need to actually do well there. Now, payment systems is another very important part of the financial sector. I'm not going to spend any time on that sector in this course. I could tell you about blockchains and this and that, but there are not jobs there. So when there are jobs, I'll talk about that in my course. Okay? As you see, my course is designed to be useful. Lots of interesting things I could talk about blockchains, lots of interesting things, but for what? I doubt any of you will have it. Maybe one of you will be working there, okay? Working at American Express or Visa, unlikely. Okay, so I won't talk about that. And then financial services. These are, some of you will be working here. Consulting companies, you'll be at KPMG, EY. And for that, I also will be very well aware that you will need to know certain things so you can go there and be successful there. So these are the 5 sectors within finance. And in this course, I will try to equip you with what you need to do well there. Now, let me look. I love history. It's very good to understand history, to understand where you are, but also what may be coming. So I don't know if you know the history of the financial sectors. I want to talk about China and Babylonia, which is where these things actually started. Not the earliest, but one of the best documented developments in finance happened during the Code of Hammurabi. I don't know if you know Hammurabi in the year 1750 BC. This was the first time, finance had already been around for over 1,000 years. But this was one of the first times that a few things were encoded. For example, temples will act as the banks. And they would actually dictate interest rates that were regulated. And the insurance sector started then. Shipping was a very big business back then. And the way the shipping business worked is if you had a ship and you transport someone's goods from A to B and something happens to those goods, then you are liable. This was before the time where we had limited liability companies, so the liability meant that you have to pay for everything. And typically that meant that you have to pay with your family, your house, everything you own. Okay, you become a slave. Not just you and your family. So then the insurance sector started, and that was codified by Hammurabi in the year 1750 BC. So this thing had been around for a long time, okay, before machine learning. And it's interesting to know. Now, the first option trade, I know that you all know what an option is, but the first option trade that I know was documented appears in the book by Aristotle, his book Politics, and describes the story of Thales de Miletus, where he was a great mathematician. You probably know his famous theorem, two parallel lines crossed by a third line produce same angles at the intersection. That was his theorem, Thales. Okay. But he did something else, which is that he observed, this is a translated version of Aristotle, he saw that one year the olive harvest was going to be very big. He predicted that. He saw olive trees had more olives than usual, so there's going to be a surplus of olives. And he didn't bet on the olive market. I don't know that you could do that at the time. But what he did is he went to a mill owner and bought the right to use the mill on a certain day. He paid some money ahead of time and said, well, I want to use your mill. So when? I don't know. I'll tell you. Oh, okay, fine. I'll take the money. The money was right. And then the story goes that when all those olives had to go into the mill to be crushed into olive oil, he showed up and exercised his option to use the mill. So it's a good story because it shows one of the things that I value very much when I teach this course, and that's the value of intelligence and wit, which you can never ignore. So that is the first documented of case of that. We're going to see options in this course, which they're in essence very similar to the one that he designed back 2,500 years ago. Okay, so apparently he made money. Now, more interesting than that for us is the creation of the first exchange. Organized exchange as we know them today, and that's the race exchange in Osaka at the end of the 16th century. And the way that worked is as follows. Rice is a very important commodity, okay, in Japan, still today. And there was a lot of price uncertainty about rice price formation. You didn't know how much rice there was going to be. If there was going to be a lot, price would drop. If not a lot, price would rise. And that creates uncertainty for consumers and for producers. So someone, and I don't know the history of this, created a rice exchange. So the rice exchange is a place where you go and you can bid to deliver rice at a fixed price in the future. So, so what you have is you have participants that go there, and they, if you are a producer, you ask for a certain price. And if you're a consumer, you bid for a certain price. And then you agree. And now you have the obligation to actually enter into that transaction in the future. And this is the first, now all exchanges work like that. But this was the first one that was created back then, 17th century in Asia, at the end of the 17th century. And that was fantastic. So fantastic that there was another city in North America, Chicago, that learned from that. And what they did is they used Chicago was not a very big city, certainly not a very important city at that time, but someone had an idea, and I don't know who that was, but it was a beautiful idea. The idea was, let's do the same thing with cereal. Cereal was traded all over the US and Canadian Midwest. Winnipeg was a very big center. It was probably bigger than Chicago and more important than Chicago. Okay? And what Chicago did is develop the concept of the clearinghouse, which is, well, you exchange your grain wherever you want, but you can come here and you can do the paper trades here. You can agree on the future price of all that stuff here in Chicago. And that made Chicago the city that it is today. It became very powerful, and now you have exchanges for everything, not just grains, which is how they started, but pork belly, orange juice, all sorts of things, okay? All sorts of things. And very likely we're gonna see those things grow. You have now climate exchanges where you can make or lose money if certain things happen in the atmosphere. And one of the areas which is, it's not in my course, but it's developing now, is the insurance industry may very well turn into this. There is this new thing called parametric insurance, where you essentially create an insurance contract which does not protect you against damages. You get compensated if certain parameters are hit. Like, for example, you get wind, sustained winds for a period of time, then you get paid. Or you get rain, sustained rain for a period of time and you get paid. Or you get sustained drought for a period of time and you get paid. This is if it succeeds commercially, it will be a fantastic development, because one of the problems that the insurance companies have today, especially with the increase in natural disasters, is that there's a very important part of the insurance claim process, which is the adjuster. You know what that is? Adjuster. If you have house insurance and your house, say, gets blown up by a hurricane, then you call the insurance company, and typically the insurance company sends an adjuster to check the damage and to figure out what the value of the repairs will be. But if that happens to 10,000 homes at the same time, they don't have 10,000 adjusters ready to go. So you could be stuck in your home for 2 months waiting for the adjuster to show up. And you can't do anything. You cannot fix anything, right? So that's the way insurance works. And in the case of natural disasters, then these things can get to be very, very uncomfortable. People in Florida know that very well. When big hurricanes happen, then call the insurance company very quickly and pray that the adjuster comes very soon. There's nothing you can do to the house. However, if you get paid on parameters being hit, like rain, wind, something like that, then you just get paid. No need for an adjuster. So insurance could become much more dynamic, faster pay, but then how do you price them? This is an area which is developing, and some of you may be involved there. We don't know. This is some of the things to come. But back then, in Chicago had this idea of creating things like that. And I like to say that because most people think of financial markets as only the stock markets. And the stock markets, of course, they're very important and they're big volumes. But in fact, they have been around for about 100 years, no longer than that. And frankly, I don't know where they will be a few years from now. My phone is getting very hot. I don't know where it is. Yeah, because it's doing the. So we started 2,500 years ago, and now I'm going to get into the last 100 years. So you understand, we're going to take a microscope to understand the last 100 years of quantitative, of finance, but especially focusing on the quantitative methods. And 100 years ago, something very interesting happened, which is that accounting was made into law. Accounting is very old. It's 6,000 years old. Egyptians were doing accounting, very delicate accounting, 6,000 years ago. But starting 100 years ago, accounting is something that you could trust. If your accounting numbers are wrong on purpose and go to jail. So that meant that now we had numbers that we could trust. And with numbers that we can trust, we start to develop quantitative methods. And that started about 100 years ago. And this is what gave rise to something you may know is called value investing. We'll talk about that a little bit today. Okay. But the big revolution happened around the year 1950, when someone by the name Harry Markovits thought about a new concept in investing, which is called risk. We'll talk about that a few weeks from now, but what I want to say is that Harry Markovits got very lucky, which is he came up with this concept exactly at the same time as computers were invented. His concept of risk without computers would have had no impact. So a technological development known as the computer is really what unleashed a lot of the mathematics that we use today. And of course, in the year 2000, everybody had, the PC changed everything again, because now everybody can have their own mathematical model and you can put it into your computer. But now what's happening, and this is going to change things dramatically, and we don't fully understand how much these things are going to change, and that is what's happening with the arrival of large language models. Because if you look at the consumption of data over all this period of time, everything has been based on numbers. But now for the first time, we can take data which is not numbers, which is driven by words, textual information. And I like to talk about GameStop at this point. I think you all know about GameStop. Yes. GameStop for me is a very good example of the new finance, where the relevant data is not given by numbers. Is given by what people talk about on Reddit, for example. Okay. Sentiment analysis is changing, and we're going to talk about that today, a little bit. In fact, I like to analyze the evolution of finance by looking at the data consumption. And actually that makes everything I just said very, very clear, because 100 years ago, what did we have? 100 years ago, all we had was company accounting information. Information that could be databases that could be written with pencil and paper. The concept of a database was fit on a piece of paper 100 years ago. Then the concept of data became time series. Why? Because we had computers. And then that grew to the year 2000, where we had Bloomberg type, and you could have historical data, real-time data, high-frequency trading started at that time. You could have data by the millisecond. Data consumption is the best indicator of the evolution of quantitative finance over all these years. And that happened over the last 70 years, essentially, right? And now the data which is consumed is textual information. And you will see that in my course, there will be not one model where I use textual information, not one. So I can tell you that my course will be obsolete very soon from that point of view. That's why I need you to learn everything that has happened, because then you will be prepared for when these things take over. Okay? Only in one of my lectures I will be addressing this. Only in one. And that's the one precisely on sustainability, which is the new finance that's developing right now. All right, so this is the last 100 years. The next topic I like to talk about is, I like to reflect on 100 years of failures, because as we will learn in this course, most of the developments that happened in finance were reactive. They were not proactive, not all, but most were reactive. Something bad happens, you fix it. Something bad happens, you fix it. And a lot of that has been the driver for a lot of the theories that we know. Not all the time, but most of the time it's been like that. And again, I want to focus on the world of stocks, just the last 100 years. Okay, if I go more than 100 years, I have to look into bonds and futures and rice and olives and things like that. But the last 100 years, I can focus on stocks. And what has happened over the last 100 years is, I have here the a graph of the Dow Jones Industrial Average Index until something. And there we have the 1929 crash. Do you know about the 1929 crash? Yes? Okay. So it's very interesting to discuss what happened in the year 1929, how that market crash happened. And the main lesson from that crash, the main lesson is that the markets were not regulated. I don't know your stance on whether you like regulation or you don't like regulation, but when they're unregulated, then you can take advantage of that. There's a very good story. For example, the CEO of the Chase National Bank, what then became Chase Manhattan and then J.P. Morgan, when he saw the problems developing in the year 1929, he shorted the shares of his own bank. He made $4 million of the time. You cannot do that today. You do not go to jail, right? Because with these things, you can manipulate markets. So a lot of that happened there. And by the way, this is what led to the Investors Advisors Act of 1933, which forced companies to report financial information, which led to the creation of accounting standards which you can respect, which led to the creation of value investing. See, it's all related, and it all happened. Why? Because of the 1929 market crash. Then we had the Iran-US oil war. That created tremendous market volatility. In fact, you're familiar with the Silicon Valley Bank? Yeah? Credit Suisse, they went under. We had two, maybe three bank failures 2-3 years ago. Well, during those years, we had 6 bank failures in the United States per year. Imagine that. So what did that give rise to? Well, financial markets were crazy. We will see some of my business cases in this course will go to those years, in particular 1982. So this is what caused the derivatives markets to be created. So derivatives markets created for 2 reasons. First, because financial problems needed financial insurance to be created, and that's what derivatives were. And then the genius of Merton, Schultz, and Fisher and others, Steve Ross and others, that gave us the technology to understand derivatives so they could be traded. And then they became multi-billion-dollar products. And that's why if in 1990 you're looking for a job, if you know these things, you will do very, very well. Today it's not enough, but in the 1990s, this is what you need to know. And then we had a very unexpected development. In 1987, we had the biggest single-day drop in the New York Stock Exchange. The S&P 500 dropped 25% in one day. And no one knew why. There was no economic reason for that. There was an investigation, and they discovered that this was the beginning of computer trading. Computers were trading options with each other, and the models were imperfect. Volatility was miscalculated by the computers, and they started to trade in crazy ways, and they make the market drop 25%. No economic reason. And we're going to see options, and options are non-linear instruments, which, you know, non-linear instruments is you change a little bit here, a lot changes over there. Right? So that created perhaps the main reason why this course exists, which is regulation again. Basel I, the Bank for International Settlements, all the central banks around the world got together and they realized that these derivatives markets that had been introduced as a way to provide insurance against the 1970s market volatility was not properly understood and not properly regulated. So risk management started at that time. And this Canadian company called Algorithmics started to develop the financial software so the banks could implement the regulatory imposed processes to calculate risk. And then they called me, and we created the Risk Lab, and this is how it all happened. And this course was created at that time too. All because of October 19, 1987, the single day biggest crash of the New York Stock Exchange. But that didn't end there. Then we had September 11, we had the Enron debacle that gave rise to the Sarbanes-Oxley. Then quantitative easing was how the United States recovered from those crises. And quantitative easing, what it did is it dropped interest rates to incredible levels that led to the creation of the structured credit in huge volumes, very similar bubble to the one that created the 1929 crash. The bubble in 1928 was stocks. People were borrowing money to buy stocks. The amount of money in 1928 that was on loan to buy stocks was more than the money in circulation. Then the crash happened. 2008 was very similar. Because rates were so low, everybody had found a way to essentially borrow money to buy all sorts of crazy securities. And all of that came to a very bitter end in 2008. I lived that first row. We had a very big portfolio at the time. And I'll tell you lots of stories about that when the time comes. But that was perhaps the biggest, deepest problem we have experienced since then. And frankly, we're still coming out of that, because then we had the Dodd-Frank Act, was imposed by Obama, then Trump repealed it, and then we're still trying to figure out what is going on with that. But as we try to figure out what's going on with that, then machine learning came and is threatening to change the core of how the financial sector works. Okay, so we'll talk about that. So that's where we are right now. We are in a period of tremendous change, and that's one of the reasons why now this course is beginning to change much more from year to year than in the past. Many things are changing. So here's a summary of the events and the regulation that gave rise to the 1929 crash, the Securities Act of 1933, the September 19, that number is wrong, 19, not 17, 1987, the biggest one-day drop of the S&P 500, the Enron collapse that gave rise to the Sarbanes-Oxley Act of 2002, the 2008 market crisis that gave rise to the Dodd-Frank, and we haven't had one on data yet, but that may come. And then we may have, right now the use of data and the use of software in the banks is largely unregulated. For example, in the airline industry, the code which is used to fly airplanes is regulated. You cannot write code in any way you want. Not in the financial sector, not yet. That may change. We're not there yet, okay? So this is how things happen. COVID-19 didn't really change much, although for years, even before COVID, we knew that this was possible, so there was a lot of talk as to how you could do that. And every time something like this happens, I want you to know that affects your career. This creates jobs, and at the same time, this destroys jobs. And you need to be very well aware of that. Okay? All right. The one part which I will take a little bit of a peek into the future, one of the few times I will be doing science fiction in these courses when I talk about climate risk and other aspects of sustainability. I don't believe climate is the big thing. Water is perhaps even more important, but a lot of this is changing the way the financial sector is moving. It's changing finance flows. And this is an area where your skills, in particular AI and machine learning, will become far, far more relevant. So I'll talk about that. I'll talk about the jobs that are coming. Okay, I'll do that much later. Okay, this is a very good time to take a break now, because everything I've given you a little bit of history, so you understand what has happened over the last 2,000 years. And now what I'm going to do is I'm going to start to address the topic of everybody needs money, so what? And that leads to the creation of financial products. So I had some questions during the break, so I think I'm going to alter slightly. I was going to show you the website and the first assignment at the end of class. I'm going to do it now. It addresses some of the questions, and then maybe at the end of class I'll do it again. So I have a course website which I do under my own. I don't use Quarkus for this. It's just I don't even have enough space on Quarkus to do it. So I do it on my own website. I've created a class on Piazza. Some of you like to use it. It doesn't mean much to me, but if you do, I created the environment to create a forum on Piazza. Now, this is not an official communication board for the course, but if it's convenient for you, why not? Let's use it. So I created that, and the link to that you can see on my website. You have the link to join that. This is just some information about the course, but then the main things are in the reading room. In the reading room is where I have the lecture notes, and the lecture notes, this is what you can see here today are the lecture notes from last year. So the ones today, you will check that they are different from the ones I'm doing today. So the ones I'm doing today, I will upload after class. Why? Because I literally just finished all the changes like this morning. Didn't have time to upload. Normally, I will upload them before class. So if you come to class, you can see there what I will be lecturing on that day. But I do change them fairly actively. You may also have here lecture notes which I will not cover in the course. I just keep them there because they may be useful. And this is my substitute for a textbook. I don't think you need a textbook. Then, as you can see, these lectures are recorded, and then I edit them and I put them on YouTube. Not only you can watch them, many other people watch them too. So I make them available on YouTube. You can actually check the lectures from previous years also on YouTube. I have a YouTube channel which is semi-active, and there I have other playlists that may be of interest. Like, for example, there's one on business skills and communication skills, which I will devote 3 hours of my lectures at the end of March. So that's all on my YouTube channel. There's one assignment which I already posted, and I will go through the assignment at the end of class today. It's on the website. You can get it. Maybe I'll share it on Quarkus also, if that's useful. It's there, and it gives very precise instructions as to what you need to do. But we'll talk about that at the right time, after I tell you about financial products, bonds in particular. For that, you're going to need some data. This is not a very data-intensive assignment, but you do have to collect data in a fairly disciplined manner every day. Every day. Not a lot, but every day. And that you can get from that link. Okay, this is the data you have to. This is the link where you can get the data from. But I'll talk about that at the right time. There are some videos from YouTube that may be useful. They address some of the topics that I address in this course. I have some papers. For example, the Merton and the Scholz Nobel laureate acceptance speech, and I have some books, and I for most of them I was able to find the U of T library link, so you can just go there and read them directly from the website. These are books which are useful, but I mean you cannot read all these books. Okay, it's just too much, right? But they are there given to you as a resource. So I'm trying to help. I'm trying to be useful. The thing that really matters for this course is what's on my lecture notes. And then if any one of these areas is particularly interesting to you or you want to know more, I have tried to help you find more. Okay. The course has, if you go to the course outline, which I don't know if you have received or read, the course outline contains the schedule, which I told you, but also contains the course evaluation. The course evaluation consists of 2 assignments that you will have. Each of them is worth 20% of the mark. There's 2. One will be due February 2nd, the other one will be due the last day of classes, March 30th. And then there's 10 quizzes. The quizzes are done through Quarkus. The first one will be assigned today. And I typically give you a week to do it. And each quiz is 5 points. That leaves for 10%, which I call participation mark. What's that? I'm not going to answer that question. I guess you know what that means, but this is my way of rewarding a certain activity I would like to happen in this course. And it's best described as follows. How many of you will be applying for graduate studies next year? Okay. How many of you do you think will be asking me for a letter of recommendation? Do you think I know who you are?
Not yet.
Not yet, exactly. Do you think I will know who you are next year? That's your objective. Okay, so I will make an attempt. I like to learn everybody's names, but it's your responsibility that I remember your name. That is perhaps a very good way to explain how that 10% is going to be given. You understand what I'm trying to say? I'm being a bit metaphorical, but if I know your name by the end of the course, you get the 10%. If I don't know who you are, maybe not. But frankly, if I don't know who you are, that may hurt you in other ways, because I'm here to help. Okay? Is that clear? All right. And part of the deal is not only have to learn your name, I have to learn how to pronounce it correctly. That may be challenging, but I will try. Okay? Are we done with that? Any other questions? Yes.
So I just want to clarify that all the assignments and quizzes in this course are going to be open book.
Yes, of course, open book. And yes, in fact, I highly recommend that you use ChatGPT or equivalent to do them.
So are all the resources on the class website going to be relevant?
Say that again?
Like the resources or the optional readings, will they be relevant in one way or another?
Yes, everything is relevant. Everything is relevant. But just wait. I mean, perhaps the quiz today will answer that question very clearly. I don't think ChatGPT will be useful for the quiz today. And I don't think ChatGPT will be very useful. Well, will be useful, definitely very useful, but it's not going to be able. I like to give assignments that ChatGPT cannot do. In fact, I'm an expert in the impossible problem. I like to give problems that have no solution, because that's how things are in practice. No one through their professional career encounters problems where there is an answer. Sometimes there is no answer, sometimes there is many possible answers, and it's how you react to them that matters. So my assignments, you will see both assignments are like that. You can ask ChatGPT, and then I say, well, I will do this, or I will do that, and I will do that. They won't tell you. ChatGPT cannot do it. If ChatGPT could do it, it's the wrong assignment. That's my theory. And by the way, I'll talk about the first assignment a little bit later, but I've been doing this first assignment forever. And I know how useful it is. In fact, let me tell you how I thought about this first assignment. I told you about the Risk Lab and how my Risk Lab people no one took more than a few hours to find a job. They were very good. And that's because they learned the right things. And because of that, I had a lot of conversations with all the hiring managers in Toronto, and they would tell me all the things that they would hate when they hire people. And one of the things that consistently came up is that these mathematicians know all these formulas and all these theories, but they can't tell me how to build a yield curve. They will give you all of these interest rate models and all of this, but they, so I have these bonds, how do you build a yield curve? You can do it. And that's my assignment. That's my first assignment. And in doing that, you will see that although in mathematically, everybody talks about the yield curve, and you give it a name, and you even draw it, how you actually do it in practice is very involved. Not difficult, involved. And there is no unique answer. And I want you to be aware of all of the ingredients that go into the creation of that yield curve. Okay? That's my first assignment. In fact, I encourage all the students when they go for a job interview and you like to boast that you've done this internship at Morgan Stanley or this and that, I would say, tell them you've built your yield curve bootstrapping calculator. That's going to impress a lot of people. Because that's what you're doing. You're building an app for something that really is very difficult to do. That's assignment number one. So, but we'll talk about that later. First, I need to tell you why we care about this, right? Okay, so I'm going to then stop the share. Financial products. Okay. Who has been in the situation when you need money? All right. What do you do when you need money? What do you do?
You could take on a line of credit.
You take a line of credit. So you go and ask for money. Okay? So you go to a bank for a line of credit, right? Or maybe you ask your parents for money. Who has done that? Yes, okay. So you ask for money. Okay. Imagine you're a company and you need money. What do? You start with, you go to a bank. What would the bank do?
They look at your business operations, they look at your balance sheet, they look at your history of repayments.
And then they say no.
Yeah.
Exactly. Right. Then what? That didn't work. A company has no parents. You can call them. Yeah, you have to talk to people and convince them to invest in your company, right? And how will you do that? What does investing in the company mean? They will become shareholders, right? So one way to raise money for your company is you sell shares in your company, and then if you can find someone who is, like I said, good enough, kind enough, they may give it to you, and then in return you give them shares, right? How much and this and that, we're not going to get into that right now. Great. So what if that doesn't work? So you go to the bank says no. Then you try to, and then that doesn't work. What do you do?
Sell bonds.
Oh, well, actually, that would be the first thing. So if you want to sell bonds, you don't sell shares, right? It's always better to use someone else's money. That's if it's a line of credit or bond, same thing, right? Someone else's money. You just promise to pay plus interest. But she's talking about shares. Shares is different. So the first thing you try is that. Then the shares doesn't work. If bonds don't work, shares don't work, what do you do?
Liquidate your inventory.
Ah, well, okay. Yeah, that's that's the bankruptcy. I don't know if that is going to raise your money. I mean, if you're going to sell assets, yeah, that's a bit extreme. But let's try to avoid. What? So, no. You need money. No. So okay, very very important. Okay, very important. Okay. So let me. Thank you for the answer. It's a fantastic answer. Okay. Do you know the difference between giving money and taking money? Because I was going to ask now, what happens? So I've asked, what do you do when you need money, right? Now, what happens when you have extra money? What do you do when you have extra money? Anybody has extra money? You don't know what to do with? Anybody? You have extra money? Yeah. Okay. What do you do with it? What do you do when you invest, right? That's what you do. So maybe you talk to the person that needs the money and say, well, I have some money. So that's the opposite, right? Don't mix the two. You'll never be rich if you confuse the two, okay? Needing money or having extra money, different, right? Okay. So what happens when you have extra money? What do? You have extra money. What are you thinking of doing? Tell us. Maybe someone here has something to sell you.
Put it in an index fund. And
Index fund. Oh, okay. You're gonna do an index fund. Okay, that's well done. Very boring, but well done. Okay. So this is what I want to talk about now. Now, give me examples of who needs money. Of course, you need money. Everybody needs money. I need money. You need money. But so who needs money? Let's go through a few examples of organizations that need money.
Hi, so my name is Fang Yu, and I'm thinking that for the previous example, so if bank doesn't work, the shareholders doesn't work. But if you have a firm, like say a place, as you're starting a firm, and this place is your asset, can we do asset back link?
Okay, that's good thinking. In fact, I'm coming to that. Okay, that's good thinking. I'm coming to that. So let's go through who needs money. So everybody here needs money, right? And you don't need money, you have extra money, but except for him, everybody else needs money? Yes? Yes? Yes, okay, everybody needs money, good. How about the University of Toronto? Do they need money? Do you need money? What do they do when they need money?
They need funds for academic research.
Yeah, the university needs money. Yeah, there's no question. What do they do? What does the University of Toronto do when they need money? Speak very loud.
Take tuition from students.
That would be one option, increase tuition. Other is they go to Queen's Park and beat on the door until they get money. The other is they call all the rich people in Toronto and ask for money, right?
Encouraging donors to donate.
Encouraging donors to donate, yes. Can they sell shares? No. They don't have shares to sell. It's a non-for-profit organization. Shares only exist for for-profit organizations. So University of Toronto, if they need, however, they can do something else. Well, okay, but the endowment, okay, so the endowment is the result of calling a lot of people and say, give me money, give me money, give me money, right? And that is, what's the endowment of the University of Toronto? Do you know?
I heard that there is, like, for the remaining tuition fee or whatever the research fee, someone helping the university to arrange to invest money.
Okay, you're talking about someone helping the university to raise money for research? Is that what you're saying?
To invest the remaining funds.
The remaining funds. Okay. So let's. So the remaining funds is the endowment of the university. How big is the endowment of the University of Toronto? You don't have ChatGPT on your phone? 3.9 billion. Really? I thought it was bigger. Okay, 3.9 billion. All right. So that is what the university has raised, asking people for it. But the university cannot sell shares. They can do that. But they can they borrow money? Can the University of Toronto borrow money? Are they borrowing money? Do they have bonds?
They better have bonds.
They have had bonds, yes. So the University of Toronto can borrow money. They cannot issue shares. Your startup, you can do both, right? Okay. Say that you are the Bank of Nova Scotia and you need money. What do?
You issue corporate treasuries. You issue corporate bonds.
You can, so back to the same thing. You issue bonds. You get someone else's money, right? If that doesn't work, let's say that you want to buy a Citibank in China, and they need $10 billion for that. What do? They issue shares. They can go for the bond market, and if they can borrow the money, they will do that. But if they cannot borrow the money, they will issue shares. Then the shareholders say, oh, that's a great deal. You can do that? I invest. So then he goes, forget about your index funds, say, no, that's a better deal, right? And then you use your money for that. So financial markets are always these type of interactions. Someone needs money, and someone has money. And the relationship between the two is what financial markets are. And financial markets are organized in financial products. Every time you do a transaction like that, you have a financial product. Could be a loan, could be a bond, could be a stock, could be some other things. Okay? That's financial markets. And no one does this for fun. Well, some people may. But most people, 99.9%, do not do this for fun. They do this because they need money. And if you have extra money, you will need money at some other time, as you said. So you better do something now. That's how these markets work. All right, so what I have here is I'm going to walk you through this discussion we just had so we understand how to think about it. I'm going to start to develop a way of thinking about things. It's about time. We've been talking for an hour. And in thinking about these financial products, we're always going to adopt two perspectives, the two that matter. The investor perspective, that's the one with money, and the issuer perspective, the one who needs the money. And this, I'm going to use a very simple Boolean argument. What's good and what's bad. In practice, things will be more shaded. And I want to start with stock. I'm going to look at you because you said stocks, right? Okay, stock. If you're an entrepreneur, for example, or you're the Bank of Nova Scotia aiming to buy a Chinese bank, and you need money, you can issue stock. What is good for you as the issuer about the stock, issuing stock? What's good for you? Yeah, you get money. But what's good? Nothing. Nothing. It's the worst way to raise money because you give up control. Of course, you want the money because what is good that you buy the Chinese bank or you create your successful company and then you are the new Elon Musk. But that way of raising money from the point of view of the issuer is bad. You would prefer something else, which I'm going to discuss. Now, if you're an investor, you're the investor, you're the guy with the money. You're the one who needs money, you're the one with the money today. Okay, so if you're the investor, the stock, what's good for it? What's good for you when you buy stock?
The chance that it goes up in value.
It's the upside, unlimited upside. What's bad?
It might flop.
You can lose everything. It's not unlimited downside. The downside is 100%. You cannot lose more than you invest in a stock. Okay, in other things, yes, but not in a stock. Okay? Now, that's if you do stocks. If you do bonds, things change. If you're the issuer, what's good about the bond? You keep the upside. You keep your company. Right? You just promise to pay back. That's all you're going to do. What's bad? Nothing bad. The bond is the best thing you can do. It's someone else's money, right? Now, if you're the issuer, if you're the investor, what's good about the bond? They have to pay you back. The only chance that they don't pay you back is if they go bankrupt, and everybody tries to avoid that. So that's good. You get security. What's bad? There's no upside, right? You could be lending money to the new Tesla and you just collect your 3%, right? And these are the things that you take into account when you make these decisions. Now, let me go back to the situation I said earlier where stock issuing fails and bond issuing fails too. Both fail. What do you do? Go home and cry? What do you do? How about this? This is financial engineering. Let's take a stock and a bond. You're desperate. You really need the money, right? How about you create, and the investor is the one that now needs to be convinced. The investor is in control. You are the weak one now. So why don't you create a product which is better for the investor than a bond and a stock? Can you come up with that product?
Stock with a minimum guaranteed price or something?
There you go. You take this and say, well, I'll give you the best thing that bonds can offer, which is the guarantee, and I give you the best thing that stocks have, which is the upside. That's called a convertible bond, by the way. It's a bond that you can convert into stock. So lend me the money, all of my assets, all of the computer equipment I'm going to buy with your money is yours. That's my guarantee. So if something goes bad, you can take it, sell it, and maybe you get 80% back. That's the guarantee. But if things go well, you take 50% of the company. That becomes very interesting now for the investor, right? So you understand this. I want you to understand the thought process. If you are the one who really, really needs this transaction, then you will take what's good about one product, what's good about the other, and create a new product out of that. That is innovation. A company who did this is a company, you may not know this company. They became very, very famous for this. It's MCI. That was the first company that dared to go after AT&T in the United States. It became a super telecommunications giant. And they did it with this, with convertible bonds. Very well planned. Right? So this is the type of innovation I want you to be aware. We're going to talk about convertible bonds a lot in this course. They are a type of derivative, but I don't want to go there. I want you to understand why someone would do it. Right? So from the investor, it's the best thing possible. Everybody would want a convertible bond. But from the point of view of the issuer, it's the worst thing you can possibly do. But if you need the money and you have no other alternative, you do it. Okay? So this is a way to think about how to do things. Now, to understand all of this, we're going to go by pieces. This is going to take us the whole course, right, to understand a lot of these nuances and this and that. But I want to start with the simplest thing. The simplest thing is the value of time. Because as we're about to find out, time will give us the value for everything that we're doing here. And the best way I have to explain this is as follows. When I was teaching this course in 2001, 2002, the internet was very weak. We had internet, but it was very weak. I used to come to class with, 50 copies of the Toronto Star. And everybody would get one, and then I would ask you to flip it. So we're going to do the same today, except it's here. Okay. I don't know where to get 50 copies of the Toronto Star anymore. And why I got the Toronto Star or the Global Mail, I forgot. It's the one that was actually downstairs from where I was teaching. So it was just easy. They just collected all the pieces, and then that's it. That was my class for the day. And I always teach on Mondays. This course has always been on, I don't know why, it's always been on Mondays. And Mondays is a wonderful day to bring newspapers to class because they have no stock listings. Right? They may have stock listings on Saturday, but no, because nothing happened yesterday. So because of that, they devote a whole page to bonds. That was the only day in the week where I had a whole page of bonds. It was perfect for my teaching. And the page looked like this. This is a page I forgot what year, 2000 and something, right? 2003, okay? And in the bond section, you have reams and reams of data with this description that you have here. It says Canada, then it says coupon, then it says maturity, then price, then yield. I want you to understand all of these things, okay? You probably already know what they are, but I still want you to understand what they are. The first column that appears is the issuing entity. By the way, when you look at the bond data for assignment number 1, it's the same thing, the issuing entity. And here we're looking at the government of Canada. Is the government of Canada raising money? Why would the government of Canada need money?
They need it.
Oh, they need it, yes. Why?
Infrastructure projects.
Yes, isn't taxes enough? They need to make investments, right? So all governments make investments. In fact, that's what governments should do. They should be making investments. But how can governments make investments? Can they issue stock? No. So they can only issue bonds. So all governments should issue bonds unless they are making no investments. If they're making no investments, that country is not going to be around for a long time, right? So yes, they need money, and the only way they have to raise money is through bonds. Can they do convertible bonds? No, because they have no stock. So that's all they can do, bonds. All right, so that's the issuer, the government of Canada, and they issue that with bonds. What are bonds? We're going to talk about bonds. So bonds are promises to pay. So you give me some money and I promise to pay you what? $100 when? At the maturity date. And until then, I'm going to give you a coupon payment. A coupon payment, so the maturity date when you get $100, and a coupon payment is the amount of money I will give you every 6 months. So for example, if I look at that bond that matures on February 1st, 2003, think we're in January 2003, then that bond has an annual coupon payment of $11.75. That means that every 6 months is going to pay the holder of that bond half that. That's exactly what that means. It's a promise to pay, coupons every 6 months, and the full amount plus the last coupon payment on the maturity date. That's what these columns mean. Okay? Now, let me look at the price column. The price column is very interesting because the price column, it says here in the newspaper, says, quotations on the bond issues in the RBC Capital Markets Canadian Bond Market Index. Yields are calculated to full maturity. Price is the final bid side price as of 5 p.m. Friday. They give us a lot of information as to what that price is, because the price of the bond, of course, will change through the day. But then at 5 p.m., they look at the bid size, not the ask, the bid, how much people are willing to offer. And they record that, they send that to the newspaper, and they print it. That's what that means. Okay? Now, what I want you to do is I want you to realize that everything that appears in these first columns is data. These are all market objects. Who is the issuer? Who promises to pay? When? Coupon. Even the price is a market object. It's not in the piece of paper that you get, but that is what you pay to get that piece of paper. These are all market objects, yes? The yield, what's the yield? The yield is a mental object. It does not exist in the market. This is created by humans. That's the most important thing I want you to realize today. I want you to understand the difference between data and creation. Everybody understands what's in yellow is market data. That defines your market. But the mental object we create is the yield. And a lot of this course is based on that, the creation of these mental objects. And you can create lots of mental objects. That's what mathematicians do. We live in mental space. And when you create mental objects, you can create the right ones, the wrong ones. The right ones are the ones that we'll try to create here, but on occasions we'll talk about the wrong ones too, because this yield is the wrong one. The wrong one at best will be misleading. At worst will make you take the wrong path. And I'm going to put a lot of emphasis in this course about how to analyze the mental objects we create. None will be perfect. There is no perfect solution to anything. We want to understand the value in each of the mental objects we create. And I like to tell everybody that as mathematicians or experts in math, your superpower is that you have a nonsense detector called mathematics, which is far more useful than your ability to calculate A, B, or C. Okay, just be aware of that. Okay, so let me focus on the mental object. How's the mental object done? It's done as follows. It's fairly involved, but you need to know all of these things. These are very, very important things. That's how the markets work. When you buy the bond, when you go and buy a piece of clothing at the store and the price says $29.99, what do you pay? You pay $29.99 plus tax. So when you buy a bond, something similar happens. It's not tax, something else. It's called the accrued interest and the coupon payment. Okay, so when you buy a bond, imagine you buy a bond today, you pay something, the price that says here, and then tomorrow you get a coupon payment. How lucky, right? What would the seller of the bond feel? They feel that if they kept the bond for one more day, they would have collected a coupon payment, they can sell it back to you. So you can agree, so well, okay, that's part of the negotiation. The problem is this, that the person that's selling you the bond may incur into a gain or a loss. And the gain or a loss, do you know accounting? Are you good with accounting? A gain or a loss, as you know, has a certain capital gains treatment. But the coupon payment is income, has a different treatment, so you cannot put them together. They need to be treated separately because we have taxes. Yes? So because of that, every time there's a transaction, there's really two amounts of money changing hands which cannot be blended. One is the actual price and the other is the accrued interest on the coupons, which is calculated exactly like this. You take the annual coupon rate, divide by 365, more or less, and multiply since the number of days since the last coupon payment. That's the accrued interest. And that's paid separately, and that's income. Right? And now, the full economic value, if you sell a bond, is then the price plus the accrued interest. Or if you're a buyer of the bond, that's the whole amount of money you need to reserve to buy the bond. So the full economic value is called the dirty price. Why is it called dirty? Because it mixes the two different types of cash flows, capital gains and income, right? But it's the full economic value. So as mathematicians, we don't care about that. We just put it together, and that gives us the full economic value of a bond. But if you're an accountant, no, don't do that. You're going to confuse all of my accounting statements, so we'll have to keep it separate. Right? But if you keep them separate, it's going to be very difficult to come up with useful economic models. If you put them together, you can do a lot of economic models, but you have to understand you're making a mistake. This is typical. There's no perfect answer. So we have to just continue one way or the other. Pick the accounting way or pick the mathematical way. If you pick the mathematical way, understand that you are conflicting possibly at the fiscal level. And if you take the accounting path, you're going to be very clean fiscally, but now it's going to be very difficult to create models for anything. Yes? Understand? Okay, so let's do both. This is how the bonds would look like when you do assignment number 1. And now in assignment number 1, I'm going to start to get into that. You're going to have to collect information about bonds and organize it in such a way so you can calculate interest rates as I'm about to explain to you what they are. Okay? Now, to do that, I need to review for you the concept of compounding. Compounding is another mental object. The market doesn't care about compounding. The market does not care about interest rates to begin with. The market only looks at prices you pay. Interest rates is a way to account for that. Account not in the accounting sense, in the mathematical sense. All right. So very often, typically, the compounding that people do is annual compounding. And it looks like that. You've seen this formula many times. I don't have to go through that. If P sub I denotes payments that will happen over time, then the discount factor R, also called as interest rates, gives us the discounted value of those payments today, which we call P. But note that everything there, except the payments PI, everything is a mental construct. The only thing that exists in the market is the PIs by themselves, nothing else. Okay? We're beginning to do a mental construct. So I could do this other mental construct. I could say, I'm going to pay you every 4 months, every 2 months in the case of the coupon payments. Every day, like in the case of credit cards, credit cards will charge you a daily interest rate. And if the compounding frequency is different, then the valuation is different. But again, these are all mental creations. So let's do the mental creation that we prefer as mathematicians. So that's the instantaneously compounded interest rate. I let n go to infinity in the formula in the middle. That, as you remember from calculus, that converges to the exponential function. Is one better than the other? No, they're all mathematical constructs. It doesn't matter. None of them exists in the markets. They're all created by humans. They're all created by us. The last one is the easiest to work with from a modeling perspective. Is the one that we're going to use most often. But sometimes you go to the bank and you sign a mortgage application, very likely you're going to be charged like the one in the middle with n equals 12. Just be aware. They're all mental objects, okay? And we're going to be experts at developing mental objects. Where we cannot fail is in the relationship between the mental object and the reality. That we cannot fail. However, I'm going to now become 100% full-fledged mathematician. And I'm going to understand everything that I just said. I'm going to move into the world of make-believe. We're going to do that very often in this course. But I warn you, now I'm going to get into the world of make-believe. I'm going to assume that I have a market where all bonds have 0 coupon payments. Why am I doing that? Well, I'm doing that because in that world of make-believe, where mathematicians love to live, I've eliminated a very important, bothersome element, which is dirty versus clean. In fact, every coupon has a single payment. So things are very easy. So let's go to that world where things are easy, and let's understand how that world works. Okay? So this is make-believe. Now, every bond will then have a single payment. And a bond is characterized by 3 simple variables. The notional also is the principal, or the amount of money you will be paid at maturity. No coupon payments. The price that you pay for it, clean, dirty is the same. No coupon payments. Right? And the other is when you get paid, the time to maturity. So every bond is specified by 3 variables only. So let's come up with a mental object that uses these 3 variables. Yes, understand what I'm doing? This is in a very simple world. So I define the yield to be that. Why am I doing this? Because I want to recover the formula from the instantaneously compounded interest rates. That's why I picked this. You know, mathematicians have a license to give definitions. They can define whatever they want. A different question is whether it's useful or not. That we don't know. But this we can define. I have the license to do that. As long as the number inside the logarithm is positive, I can do that. And even if it's negative, you allow me complex numbers, I can do it too. But then why would you do that? I don't know, but I can do it. Right? So I can do that because I'm a mathematician. I have a license to define. So I do that. But I know why I'm doing this, because this will help me recover the instantaneously compounded interest rates. So we all agree that this is the right way to go. That's the bond price, that's my notional, that's the time to maturity, and the result is an object, which is now called the yield. By the way, this yield, except for the compounding detail, is the same as the yield in the newspaper. The same. Okay? Now, this is great because if, again, I'm in the world of make-believe, I'm not going to leave that world yet, but if I had all those bonds, imagine now you give me another bond with coupon payments. Coupon payments denoted by numbers P sub I. That will happen at times T sub I. And I already know the interest rate R at T sub I, because I did that from my zero coupon bonds. So if I do that, then I can calculate the value of my discounted cash flows. Why? Because I think of my coupon-bearing bond as a portfolio of zero coupon bonds. The first zero coupon bonds pays me the first coupon payment at time T sub 1. The second coupon payment is a different bond that will happen at time T sub 2, and so on and so forth. So a coupon-bearing bond is a portfolio of zero coupon bonds, and therefore they need to be priced like that. Understand? You all with me? What happens if the price is not that? Are we wrong? Okay, so if the price is not that, we're going to be very practical. If the price is not, say the price is what? Is more than that? Oh my God, then someone is selling a bond above market price. What do? Call them and tell them they made a mistake? What do? You're the one with the money. What do?
You take advantage of it.
You take advantage of it. You buy the zero coupon bonds cheaply, and then you go buy then you sell the expensive bond, and then you make a profit. You don't tell them anything. You don't tell them you're wrong. No. You're right. And I'm going to make a profit, which is the difference, right? That's why these things don't happen, because some people may be under pressure to sell, but someone is going to show up very quickly with money and say, no, I'll take that. Right? And that's why we say here in the classroom that the price is the same. But out there in the market, the price might be different. But you've taken this class, you know the price is wrong, you take advantage of it. And you thank them. That's how we do it. Yes? Okay, well, in any way, if in my world of make-believe, if I know the zero coupon bonds for all possible maturity times, then I can price anything. Any other series of cash flows. That's very powerful, right? Okay, so how likely is that I can do that? Well, let's go back to the world of coupon-bearing bonds. Let's go back to that world, okay? The real world. In the real world, what I realize is that every bond that matures in less than 6 months is actually a zero coupon bond. And now I'm the mathematician, I'm not the accountant. The accountant says, no, there's a coupon payment in the end, and that is taxable differently from, yeah, I know. Okay, but I'm the mathematician now. So I can calculate the yield of that bond using the dirty price with the same formula as before. Again, the formula is the one that allows me to recover the instantaneously compounded interest rates. And that's true whenever my coupon payment is less than 6 months. There's a mistake there. It's 0 less than T less than a half. But now what happens when I have a bond that has maturity less than a year, more than 6 months, but less than a year? What happens? It has 2 payments. The first payment will happen in less than 6 months, so it can be discounted by an interest rate which I've already calculated for a different bond. And this is the magic. I'm using a yield from a different bond to calculate the value of another bond. Why? Because we just saw earlier that the yields have to be the same. My yields, not the yields in the newspaper. Because of that, the yields in the newspaper, everybody calls them yields. I call them yield to maturity. My yields, I call them yields. Other people call them spot rates. Okay. Sorry, the vocabulary is a mess. No problem. We know what we're talking about. You understand what I'm doing. I'm creating mental objects with certain purpose in mind. So if I look at this equation that I have here, with 2 coupon payments, I realize that the first coupon payment is a number that I know, taking the R of T1 from a different bond. And the R of T2, I don't know what it is, but that's an equation with one unknown. You know how to solve equations with one unknown. You're that strong. Yes. Right? Take this into the other side, divide by that, take logarithms, divide, you get it. Right? Good. Wonderful. That means we have now found the yield curve. We found the rates for everything between 6 months and a year. And you're smart. What happens if I have a bond that now matures in more than a year, but less than a year and a half? What happens? What happens?
You just do the same thing. You just do the same thing.
The same. You have now 3 payments. 2 of them you discount with rates you already calculated, because the magic is that rates for one bond work for another bond. And then you can calculate the curve for a year to a year and a half, and then from a year and a half to 2 years, and so on and so forth. This is your assignment number 1, by the way. Looks simple. Yes? It's not hard, but you'll have to make lots of decisions because things don't quite work out when you do these things in practice. And you're going to find out. You will become experts in everything that can go wrong when you do this. Because as you know, when you work with real data, you don't know, right? Okay, so that's a dirty price. Don't make that mistake. Very often people make the mistake, they take that to be the price on the newspaper or on the website. No, that's not the clean price. It has to be the dirty price. It's a price that captures all of the economic value of the bond. We're mixing income and capital gains. Big deal. This is not a course on tax credits, something else. Not yet. Right? Understand? Great. That's the rate from the previous bond, and that's the real unknown. That's the one that we have to solve. Okay, so I have here a worked out example for you. I've done it for you, so you can see how this thing works. You have to do the same as this, but in real, with real data. Oh, it's the same, almost the same, but it feels very different, okay? So imagine it's the year 2000, we're January 1st, 2000, and then I give you these bonds that we have here, 6. You have to take, I think, 10 in your assignment. Here, take 6. And these are the dates, and these are the prices, and these are the coupon payments, just like you will have. Note that I've only taken the market data. I did not include the mental objects, the one called yield, because that's the one I'm going to do, but I'm going to do the right one, not the wrong one. Okay, so for that, what I do is the first thing I do is I take all of my clean prices and make them dirty. First thing. Next, I go to the bonds that mature in less than 6 months and calculate the yield. Next, I go to all of the bonds that mature between 6 and 12 months and calculate the new yield. The yield at 3/4 of a year and the yield at 1 year. This is in the notes. You can just go this. I suggest you go through these numbers yourself. There's no way you learn anything by just watching me do this. You have to do it yourself. And I suggest you do this before you do the one for real with the real data. You understand this? And then you take the one for real. So I suggest you do this today. Okay? and then, and then. And that's your yield curve. That's your assignment number one, in a very simple, idealized solution. Now, imagine I had, and this is one of the things that can go wrong. Imagine I had a bond maturing on December 1st, 2000, with a coupon payment 4% and 30 price of 100. What happens then? Well, I try to calculate with my coupon payment, and then I see that I need, in that equation for the bond, I have two new unknowns, out of a third and out of 5, 6. However that's 4 months and 10 months. But I don't have those yields. I don't have zero coupon bonds that mature exactly. Then what do? Go home and cry?
You just draw a line.
That's what I'm doing. I draw a line. Messy, right? Mathematically, this is incorrect. But what can you do? You have to trade. And you don't have very much time. Someone is going to buy that bond. You do the line. That's what I'm doing. Understand? I cannot tell you a mathematical theorem that says that this is the right thing to do. In fact, I could probably prove a mathematical theorem that says that this is the wrong thing to do. But you have to do something. So let's do that. And you will have to do something similar. Okay? And what if you have a holiday in the middle? There are no payments. Oh, this is the line that you're doing, right? And where do you have other things? Like you have to, a coupon payment falls on a Sunday. You don't pay on a Sunday. You pay on what? Friday or Monday. But that introduces another inaccuracy. In your assignment, you can ignore that. But do me a favor, when you go and work, you cannot ignore that. You get fired. You cannot ignore that a certain day is a holiday. Understand what I'm saying? So this assignment is very good preparation for what lies ahead. Are you good with this? This thing we have done is very, very deep. We've created our first non-trivial mental object, and it's an entire curve. And it's a curve which has some very nice properties. The most important property is that the yield on the newspaper, you look at that yield is a function of bond. Every bond has a certain number, and different bonds have different numbers. Some people think that bonds get mapped into dates, and then dates get mapped into numbers. So it's the same thing as I'm saying that if my 2-year bond has a rate of 3, then the 2-year rate is 3. Right or wrong? Wrong. Wrong. Because I could have another bond that matures on the same day with a different yield if it has different coupon payments. So we have come up with a one-to-one correspondence between time and rates. And it's the only one. There are no others. This is unique. We've managed to price time. That's what we have done. Whereas the yield in the newspaper only prices bonds. Big deal. Pricing bonds, pricing time. What's more important? Time. Because in fact, I can continue and I can now talk about stocks. By the way, some people think that a stock is something that you buy low to sell high. Tell that to an entrepreneur, right? Now, what is a stock? A stock is an investment that has payments in the future. You have some payments that will happen at certain points in time. It looks like a bond, but there are some differences. The first is that the future payments, which could be dividends, sale proceeds, other things, are not deterministic, they are stochastic. We don't know what they are. In a bond, we know what they are. It's a promise to pay, and they will pay exactly that. In the case of stocks, we don't know. In fact, we don't even know the sign. Those P's could be positive if we get dividend payments, but maybe we have to make further investments and then they become negative. We don't even know. And we don't even know the time on which things will happen. Like a bond, though, stock prices cannot become negative. That they cannot do. Why? Stock prices could be negative up until the year 1700. That's when the new security called the stock was created in England. And British law developed the concept of limited liability companies. And you know the reason? The reason is, up until then, most enterprises were individual enterprises. People just did this on their own. And if things go bad for you, sorry, you still have to pay. You borrowed money, you have to pay back. Even in the Code of Hammurabi, he said that. But around the time of the Industrial Revolution, a lot of these companies were no longer done by individuals. That's why they are called companies. And people had to pool their money and their assets to do new enterprises. And then you say, well, something goes bad, whose house do we? And then the concept of limited liability came up because it was the easiest way to move forward. And you know, one of the first companies that was created under this new regime, it's a Canadian company. Which one? Bell. Bell, the telephone. In 1689, no. The Bay. The Bay. The Bay. Do you know the actual name of the Bay? No. Can you find out the name? Please ask ChatGPT. No, it's a fantastic, it went bankrupt last year. I will have to continue. I don't know how many more years I'll be talking about. I'll be lecturing this course, but I will talk about the Bay up until it was one of the first companies created under the new limited liability regime. Someone give me the name of the company. Huh? No. It's a full sentence. That's why I cannot remember. Well, you find out the name on, you know what their asset was? They had the king's permission to hunt for seals in the Hudson Bay. That was their asset. That was their one asset. Read it. No, you read it.
Is it like the governor and company of adventures of England trading into Hudson's Bay?
There you go. Okay, so they kept the first and the last word, the Bay. But it's all of that. It's one of the first companies created under this. So yes, stock prices cannot become negative. Not since 1701 or something like that. Okay? Very important. It's going to become important to us later. Now, how would you do stock valuation? Can you use any of the things we have done here? Well, not really, because the stochasticity of the payments is so huge that we can't do that. However, the main component that we have just uncovered, pricing time, continues to be relevant. So we have tremendous complexity when dealing with stocks. The company profitability. Who can know what the profitability of the company is going to? I don't know. A bond, yes. I know exactly what I will be paid exactly when. But a company, I don't know. So you may know that there's a way to price companies. It's called the discounted expected cash flows. It's called DCF, discounted cash flows, DCF. And what they do there is they just look at the company and think about it and say, well, I think they're going to give me this dividend here. Look at the business plan. This dividend. You discount it by 70%. Okay. They say, well, and then you're going to get money, expected money. You see, expected money in the future. You discount that with exactly the same yield as the one we got for the bonds. And that gives you the value of the company. But this is voodoo. This is so much more complicated. We don't know what this is, right? So we will get into that. When we talk about investments, we will talk into that. Because it really is voodoo. We don't know how much we're going to get paid when we invest in a company. We don't know when. And we don't know for how long. So pricing the stock looks like impossible. Well, But you have to do it. People, when they look for investment opportunities, you have to do it. People are buying and selling stocks right now in billions of volumes. So someone needs to know something, right? So sometimes to hide and say, well, it's difficult, I don't know the answer, it doesn't work. And that's something which in this course is not valid. Okay, we cannot do that. You may know about value investing. Value investing is a methodology to attempt to calculate this using accounting information that you have now. And growth investing, or GARP, growth, we're going to see this later, in 2 months. That's calculating the value of a stock, taking into account future cash flows. Like Facebook, when it went IPO, what was the value according to their financials at the time? 0. Their revenue was 0. Then they sold for about over $1 billion. Why? Because people were making a bet on the future. So people disagreed on the future value, and the people that thought the value was higher than other people thought, they bought the stock. And that's when finance happens. Finance always happens, well, not always. Most of the time, finance happens because of disagreements. If everybody agreed on the price, there will be very little trading. There will be some, but very little, right? You still trade rice because some produce rice, some have to eat rice. But except for that, except for the necessities, you will only trade if you disagree on that. And I have here an example about disagreement. This is just for inspiration for what's coming next. And I'm about to finish my lecture today. I want to introduce an element of decision making here. It's something which is becoming increasingly important in finance these days. I want to play 2 games with you. Okay? I'm not going to take a break. We're going to finish early. Okay? So let me just continue. So I want to play 2 games. In game 1, I'm going to give you a choice. You're going to make $900 for sure. I give you $900, you go home. I'm not going to ask you how much you pay for that. That's a different question, okay? But that's your for choice number 1. Choice number 2 is you're going to gamble. There's a 90% chance you make $1,000 and a 10% chance you make nothing. Can I have show of hands? Who would gamble? Oh, they all win the money. Who would not gamble? Who would just take the $900 and go home? Yeah, it's always 90% of the people. Okay, we're going to change the game a little bit now. In the second game, you're going to lose money for sure. You're going to get a fine. You're going to have to pay $900. Or you can gamble. Let me have a show of hands. Who would gamble? 90% of the people. Why? Explain this to a machine.
People feel pain differently.
The thing is that the brain, now we talk about the human brain. The human brain is a fantastic machine. It's actually a fantastic risk management machine. Part of the reason that people have anxiety is because of that. The human brain is very good at generating future scenarios, especially the bad ones. Psychologists tell you that 91% of the things you imagine will not happen. They're all bad, by the way. Okay? So we are wired to run away from risk. That's why perhaps we're alive. Okay, perhaps. But if you're a banker and you know this, what do? You create a new game. You trade with each other. Modify the numbers a little bit, and you make $1 per transaction. Right? So finance happens when disagreements occur, and typically the financial intermediaries, namely the banks, are there to take advantage of that. And this is what this course is going to be about, from now until the very end. Today we have learned about bonds and the yield curve. We've created our first mathematical object, which I know I could lecture about that for months and months and months. You will only understand when you do it. And that's why your assignment number 1 is when you will learn this. The assignment number 1 is very long, and I ask you a lot of questions, and you're going to answer them and this and that, but I'll go to the heart of what you're doing. And I want to spend time on this. I want you to understand the significance of everything you are doing here because it's very, very important. At first sight, I'm going to ask you to calculate the yield curve just like I did here. I did it with 6 bonds. You're going to do it, I forgot, with 5 or 10. I forgot. Whatever is written there is written. You read it. I cannot read in public. I don't read in public. Okay? So you're going to, it's exactly the same. But you're going to run into a lot of issues. Oh my God, this rate, I don't know it. What do? I interpolate, right? Or something will happen. But then once you have your curve, you have not just one curve. You have 10 curves because you're going to start today and you're going to do that for 2 weeks. That's 10 days. And with 10 days, what I'm going to ask you to do is to do something which is really, really revolutionary and very few people know. You will use linear algebra to understand the market dynamics, how fixed income markets move. You're going to do it yourselves. And you're going to do it as follows. The first thing you have to do is you have to take its rate, say the 1-year rate. The 1-year rate is something today, something tomorrow. It'll change every day. Okay, so very important. Those of you who know a lot of statistics will understand that time series of the 1-year rate has what's called a zero root. So you need to differentiate that series. Differentiate means you take the return, the actual percentage change of the rate. It's a percentage change of a percent rate. It's all explained there, okay? See the logarithm. The percentage rate and the logarithm are the same. And then you're going to have a time series, but not of one number, but of 5 numbers. I think it's 5 or 10, 5. So it's a time series of a vector of dimension 5. And then I want to ask you to trust me and do the following calculation. Calculate the variance-covariance matrix of that time series. Easy. ChatGPT will do that for you. And then you're going to trust me again, and I'm going to ask you to calculate the values of the eigenvalues and eigenvectors of that variance-covariance matrix. And again, ChatGPT will do it for you. And here the magic happens. What is the eigenvalue with the largest, what is the eigenvector with the largest eigenvalue you're going to come up with? I already know. This is like when people play the cards, I know it. It's 1, 1, 1, 1, 1. Very close. Why? You have to know a little bit about linear algebra and a bit about eigenvalues.